So last night had a few interesting things. ECB came out and provided dovish comments in that interest rates may be going lower, but then Barkin, who's a member of the Fed, came out and said no. Well, that's the ECB, right? So that's the euro, and the euro weakened off the back of that. But Barkin and stocks took off. But Barkin came out and said, well, no, interest rates higher for longer. Plus, the US had this pretty ordinary number. So we saw stocks run up on the ECB, but then quickly come back, and so that's the ECB, and then the Fed came out, and then it just went sideways. Also over in bond land, similar story but opposite, in that bonds came off, but then retraced most of that to pretty much end the day unchanged, as you can see there. Elsewhere, VIX is not doing much, just going sideways, and that's about it. So we've got BOJ today, and there's been a lot of well, I guess if we're going to have a look at what's happening in the BOJs, right? So we've got this band run by the BOJ to try and contain interest rates. This is part of their quantitative easing program, and the 10-year bonds are breaking above that, right? So it's putting into question the whole BOJ policy, and do they have the ability to manage their bond market, which is the world's largest bond market. So a little difficult for them to do that. So today might be interesting for the yen and where that's going to go, because predominantly they intervene in the actual currency, but they might also be intervening in the bond market as well. So eyes up for that. That's out this afternoon, Australian time. Another thing I also want to point out is these two charts, right? So this is going back to the US interest rates, where what they're not wanting to see happen is what happened during the 80s, right? So inflation during the 80s is this blue line, and you can see that it peaked up here, and they raised interest rates to try and beat that, and when that started to show some weakness, they dropped interest rates significantly, right? So from 19% back down to 11%, and inflation did carry down lower, but then within that 12-month period, inflation picked up again, and so interest rates ran back up from back down to sort of 9%, and then back up to 19%. So this scenario is what the Fed is trying to avoid, and why they continue to say they will be higher for longer, right? And they will maintain interest rates at a level until inflation is well under control, not just a sign of it, it's weakening, which is what it's doing. It's gone from 9% down to 6 point, I'm not sure if they did actually get to 9, but it is dropping, right? But it's not back to where they want it. So they will continue to keep interest rates higher for longer until inflation is well under control. As you can see, they've sort of held them up here for a long time to try and control inflation, and then sort of started to drop it as inflation fell. And that's where the scenario that the Fed's battling now. Right? So interest rates will remain higher for longer, and the stock market's got it wrong, to my mind, and the stocks up here are ridiculous, mind you. Certainly Aussie stocks up here is ridiculous. We saw euro dollar weakness on the back of ECB, but as I said, I think this dip is going to be pretty shallow, because it didn't actually get exhausted. So keep an eye out for that. And the Aussie did dip yesterday a little bit, but is now running again. And that's more about the commodity story. China says they've got great data and they're opening their doors again. Excuse me, opening their doors for business, and that's probably what's supporting the Aussie. But whether or not that data is true and China will actually come through because they're looking at the economic releases, it's not all that great. Other chart I wanted to show you was also on the US economic front is what they call the Goldilocks. So financial conditions are getting away from where the actual interest rates, the yield curve, which is indicating a recession. And last time we had this disparity, the yield curve tracked sideways and stocks fell. So this disparity here is probably larger on a percentage basis than it was back there. So again, expect stocks to fall back down, and don't expect interest rates or the yield curve to unwind and go back up. So again, more pain ahead of us for stocks. So with that in mind, you want to be fading stocks off any sort of resistance level, such as what's showing now. That's about it for today. We'll see you again tomorrow.